Welcome back. Hey, you're doing awesome. I only say that because I know this sometimes feels lonely. You're like sitting at home and it's just you in a room, or you're sitting at your office, and you might not feel like you have a partner right this second, but you do, because I've been in the same position that you in, and I know it feels lonely at times. Don't let it. Think about all the lives that you're going to change when you start teaching the content. That's what you should be focusing on. Cool. Let's get into this. On page 5, we lay out a model. I want to recapture this idea really quickly. The best courses are the ones that give you a model, which is, this is on one page exactly what we're doing. Then a system, which is step by step, how do I do it? And then the tools that you need. We're at the model phase. I'm going to take you through the model. We called it thriving in the mortgage market of the moment. There is a mortgage market of the moment, and it's that people are highly rate sensitive. Step 1. Understand the market of the moment. That means that we understand the opportunities and the limitations of the current market. We don't do that with any emotion. They are what they are. All we're doing is observing it and understanding the need. You see, if we don't understand the need, we can't possibly come up with the right MOFR. Step 2, understand the current mortgage solutions available. Remember, there's only 2 ways to sell something. Number 1, solve a problem. Number 2, present an opportunity. The problem wasn't created by you, but we're going to find the current mortgage solutions to solve it. Number 3, understand the mortgage product hacks. These are for people that really want to understand what lenders are creating. You see, they're creating new programs every single day. That's their job. If you don't understand what they are, you can't possibly hope to go out and give perspective to the consumer. Number 4, understand mortgage hacks for current homeowners. Remember, everyone in your database falls into those 3 buckets. There's a ton of people that have mortgages that want to know how to pay less. And you take it for granted that you know and that they know, but I'm telling you, they don't. Number 5, know the mortgage products that your lender offers. This is really important and often overlooked. You see, when we were doing the research for this, we found that every lender offered different products. So if you don't know what products your lender has, you can't possibly hope to be the economist or a fiduciary who's really keeping your eye out on it. How do you even know what to suggest? Number 6, market and advertise the mortgage products and hacks. This is wildly important. You see, this is making sure that your video matches your audio. If you wake up every day and you say, I want to affect as many people positively as I can, and I'm a real estate agent and I want to generate as many leads as I can, you know that helping people save money on their mortgage and helping people get over the fear of the high interest rate is what they need to hear. But just knowing it isn't good enough. You have to actually then start teaching it and using it as a MOFR. Number 7, market mortgage products and hacks to your database. What's the difference between number 6 and number 7? Number 6 is about bringing new customers who are motivated into your pipeline. Number 7 is about saying, I have this data bank full of people. How do I get closer to them emotionally so that I can do business with them when they're ready to do business? That's the model. Now let's get into this thing. Step number 1, understand the market of the moment. I'm going to read this. Being the best fiduciary possible. I'm going to stop right there. You do realize that being the best fiduciary possible should be the goal of every single real estate agent. Now here's my question to you. Do you think that that's the goal of every single mortgage executive? I'm not going to say whether I agree or disagree. I am going to say in polling, most of you said no. And why is that? Well, because a lot of times mortgage executives are not actually fiduciaries to the consumer. They don't profess to be. You see, they work for the bank, which means that's who they're a fiduciary for. The real estate agent, on the other hand, is the fiduciary for the consumer. So real estate agents who say they don't need to know this because it's their lender's job, they've done a grave disservice to their customer. That's not a debatable fact, friends. That is the fact. This begins with being the best local economist of choice for those seeking information about the marketplace. Real estate agents perform at their best when they are either solving a problem that the customer has or presenting an opportunity to a customer that can better their life. Friends, I could not have said that better than myself. Gary Keller said it. Both of these things are only possible when real estate agents have a deep understanding of their market dynamics and the real problems that need to be overcome for the consumer to transact. So how do you go about figuring out what is the market of the moment? Well, we gave you some suggestions. Number one, just ask them. The easiest way to understand the problems that buyers and sellers are having is to simply speak to as many of them as possible. Start asking questions like, what concerns you most right now about buying a home? As you think about selling your property, what's your biggest fear? You see, after asking enough people questions like these, the answer will begin to match each other. When the same answer keeps coming up, that's a problem that's worth solving at scale. Friends, that's the exact same thing in the brokerage business. If you went out and you asked 20% of the real estate agents in your market, I know that's never going to happen because math, but if you did, what are your 3 biggest challenges facing a real estate agent today? Do you think at the end of doing that, you would know which problems you need to solve? Yeah, of course you would. Here's the good news. I already did it. And I can tell you, when asked, here's what they said. Leads and appointments. That's the biggest challenge they have, and they want more of them. Number 2, technology. I want the technology to make me more human more often and do more things at a lower cost. That's what they said. My hope is that all of you are answering those questions at scale in your market center through Team Ridge and a whole bunch of different offerings. What the consumer said is interest rates. That's what they said. Why would I trade a low interest rate for a high interest rate? Why would I buy something today that's going to be worth less tomorrow? Not worthless, but worth less. And number 3, I'm waiting for rates to come down. Next, data is abundant. There's so many surveys that have been conducted with both buyer and seller sentiments that a real estate agent can use to determine the most pervasive problems that their clients are facing. Friends, the National Associations of Realtors is great at this. I would urge all of our agents to go there, click on Research and Statistic, and read what they're finding that the consumer is saying. I would tell you that that's one of the most underutilized things that NAR does, and I believe that NAR does that. That might be the number one thing that they do, if you asked me. Then, local and national events. Market centers, mortgage and title companies, and KWRI all host regular events. Guys, Gary Keller's annual vision speech is literally the place during the consumer section that talks about exactly what buyers and sellers are worried about and what they want. You can watch them on YouTube, you can Google them. If you're new here, they're easy to find. Remember, all we're trying to do in step 1 is understand the market of the moment. By its mere name, it means that it's always changing, which means that if you think you know the answer in your marketplace at all times and you're not doing any of these things, and oh, by the way, the answer has been the same for the last 50 years, you're wrong. The market changes. You have to understand what it needs at any given time. That's part of being a leader. Let's move on to step 2. Now that we know the problem, we now have to understand the current mortgage solutions that are available. Take a breath, because now we're going to get into the math of this whole thing. Because the truth of it is when we talk about financing a home, we're traditionally talking about a 30-year fixed mortgage. In good markets, that's the only mortgage product that's ever discussed. It's widely accepted as the mortgage instrument to use. According to a Washington-backed mortgage guarantor, Freddie Mac, 90% of homeowners still choose a 30-year fixed mortgage. Friends, 90%. But why is that? Well, it has a lot to do with the way that mortgages came into existence. Now, don't zone out on me because this is important to understand. The large-scale concept of mortgages, this first surfaced in England and began moving west around 1190, which is crazy to think about. Then there's this wild wave of immigrants into the United States in the 1800s and 1900s, which accelerated the need for mortgages due to the lack of affordable housing. You see, initially, and I didn't know this, initially mortgages were given on a 5-year repayment plan. Stop the madness for a minute. Imagine, right now you have an average sales price of $395,000 to $410,000 nationwide. Imagine if everybody had to pay it back over 5 years. How many of you, forget your friends, how many of you would be able to buy a house? That's crazy. The payments were calculated that were interest only, and then at the end of the 5th year, the entire principal balance is due. If that was the only product available today, how many defaults do you think they would have? This type of loan is commonly referred to as a balloon note. It's rarely used by financial institutions in housing today because what happened? Well, history lesson, the Great Depression happened. You see, the Great Depression happened and then many banks, they were undercapitalized. And many of the customers, they had little to no liquidity. They lost it all. As part of Roosevelt's New Deal, the federal government created FHA. What does FHA stand for? Federal Housing Administration. This new agency, this was authorized to insure home mortgage loans made by the banks. This changed everything. You see, as soon as that happens, this encouraged banks to provide more loans to prospective borrowers. And now all of a sudden we were off and running. You see, FHA helped to create the mortgage solutions that you see today. Quality standards, lower down payment requirements, 15 and 30-year loans, and amortization payments and timetables that made homes affordable to have. The mortgage industry and the products it offers continued to evolve. You see, it just keeps going. And as what's needed in the moment changes, banks come up with new stuff. You see, understanding the programs is vital for a real estate agent to perform the highest level of fiduciary. Sit with me here for a minute. Think about that. If all of a sudden there's a whole bunch of new products that hit the market and you don't know about them, how can you possibly say that you're the highest level fiduciary? Well, you can't. And if you can't say that, then what can you say? I'm pretty good at this. That doesn't sell. Opening a conversation with a buyer or seller to help them get the most out of the mortgage products offered today might look like this. And this is the truth, but listen to me for a minute. When the real estate market changes, we need mortgage products that provide more options. We call those hacks. What I'd like to do is go through some potential hacks that'll help you get through these times and set you up to come out on top financially. Would that be okay? Great conversation. Friends, no one is saying no to that. No one is saying no to that. Now, let's get into understanding the mortgage product hacks. Now, what we did here on this page is we listed out a whole bunch of different mortgage products that are available today at scale. We did buy downs, we did 5/1 ARMs, we did 15-year mortgages, we did 40-year mortgages, we did the lock and shop through Keller Mortgage, we did seller financing, trust deed wraparound mortgages, and we did home buyer assistance programs. What I'm not going to do is read each of these to you. What I am going to do, though, is I'm going to explain to you exactly how we did it. So turn to the buy down page for a second. That's number one. What we're going to do on each of these pages is we gave you a brief description of exactly what the thing is. We then told you how it works, and we then told you what value it has to the client. This is wildly important. The value that it has to the client should help you figure out which clients to explain this to. Then it came time to do math. Now, breathe with me for a second, because when it comes to math, if it can't be done in 3% or 6%, I got a hard time with it. I'm not a mathematician. To make this easier for you, we built all of these tables. Now, there's some consistencies throughout the entire book. Number one, the purchase price is always the same. It's always $500,000. Number two, the down payment is always the same. It's 5%. Number three, the quoted interest rate is always the same. It's 7%. Those things stay static throughout the rest of the book. So as you go through, spend some time looking at this math to truly understand it. I'm going to take you through one of these so that you can understand, and then you can figure out how you want to go explain the others. See, there are a few common buy-down products that a client can take advantage of, including the interest rate buy-down, 3-2-1 buy-down, and 2-1 buy-down. How many of you know what a 3-2-1 buy-down is? Show of hands. Okay. How many of you know what a 2-1 buy-down is? Okay, cool. In our polling, about 50% of any room we taught this in didn't know. And by the way, another 61% said they did know, but then when questions didn't get it right. Which means I'm not convinced anyone actually knows. Mainly because we haven't had to use this product in the last 15 years. The following examples reference sellers paying for the buy-down specifically. Buyers and lenders can also pay interest rate buy-downs, but this one says sellers are. Why did we do that? You see, as there's more and more inventory that's hitting the market, and as the average days on market elongates, the buyer has a little more leverage in the offers that they're making. So what can they negotiate? Well, anything. One of the things that they could start asking for is for the seller to buy down their points. A rate buy down is a way to pay for a lower interest rate by purchasing discount or mortgage points. Buy downs can be a benefit to both buyers and sellers. Sellers get a competitive advantage. Buyers get to make a one-time payment to reduce their interest rate for the life of the loan. A common misconception is that 1% equals 1 point. In reality, approximately 1 point actually equals 0.25%. This means that if someone wanted to buy down a full percentage point, they would need 4 points. You follow me? Perfect. Buying down the rate by 1 point costs 1% of the loan amount. Here's the math on a 30-year mortgage. And as you go through here, you see on this first column, this was with no points. You can see that the monthly payment is $3,160 and that the total interest paid over the life of the loan, anytime we say that, we mean they go the full 30 years, is going to be $662,667. The next column shows you if they bought down 1 point. Remember, everything at the top stayed the same. It's still a $500,000 purchase price, a 5% down payment, a 7% quoted interest rate, but now instead of a 7% interest rate, you see interest rate with buy down. Now it's 1 point, remember, which is equivalent to 0.25%, so it's 6.75% instead of 7. Well, friends, all of a sudden things started changing. The monthly payment went down to $3,081. The total interest over life of the loan went to $634,000. The monthly savings was $79. The interest savings over the life of the loan was $28,000 and change. And the cost, in this case to the seller, because remember, when the buyer made the offer, the buyer said, I want 1 point buy down, it cost the seller $4,750. Think about this. On a $500,000 house, the seller spent $4,750. The buyer, if they go term, saved $28,000. Talk about a great deal if you're the buyer. And saved $79 a month. Now take it to the next column and look at what 3 points would have done, because now the interest rate goes to 6.25%. The monthly payment, we're not talking $3,160 anymore, friends. We're in the twos now, $2,925. They save $84,000 and change, almost $85,000 if they go term, plus they save $235 a month. Now we're talking about real money. It cost the seller $14,250. So think about this. If you're representing a seller, the $14,000 that they're spending here may be less than the price reduction that you might want them to make and have a heck of a lot more impact to the buyer. If you're representing the buyer, it's a great thing to ask for because sellers are coming off of their sales prices right now, and what a great way to save money every single month. Maybe more impactful than simply paying a little less for the home. So if you didn't know what a buy down was, you now do. So let's stop for a second and make a list, a short list of all of the customers that we think we have in our current pipelines that are buyers that might be interested in getting a buy down. Spoiler alert, it's every single now buyer that you have. Now, let's make another list of the sellers that we're representing right now that might choose to offer a buy down. Spoiler alert. It's all of them that you are about to talk about a price reduction with. This might be a far more effective way to get more bang for their buck. You get it? Awesome. Now, as we continue to go through, you'll learn different types of buy downs. The next page is a 3-2-1 buy down, and you can see exactly how that works. The page after that is a 2-1 buy down, and you can see exactly how that works. Now you're starting to roll. That's number one, buy downs. Now let's get into ARMs. Now most of you know what an ARM is, but just to recapture, an ARM, and in this case we're showing a 5-1 ARM. A 5-1 ARM is a type of adjustable rate mortgage loan, ARM, with a fixed interest rate for the first 5 years. Then after 5 years, the 5-1 ARM switches to an adjustable interest rate for the remainder of the life of the loan. Most real estate agents that lived through the last recession are familiar with this. The interest rate for year 1 to 5 is a fixed rate. Generally, these are offered at a lower rate than the traditional fixed mortgage. Year 6, for the rest of the loan, they can change every year, and they're usually subject based on the state of the economy and the cost of borrowing. Here's what's important. You can do a 5-1 ARM, you can do a 7-1 ARM, you can do a 7-6 ARM. There's all kinds of ARM products. And the question is this. Number one, do I believe that the interest rates are going to come down within this period of time? Because at any point I'm able to refinance. That's really what we're asking. The concept here that's wildly important is the date the rate but marry the home. This is to say that the home might not change, but the interest rate will change several times during the life of it as long as your consumer is refinancing. Learn about ARMs. Next, we have the 15-year mortgage. Now, the pushback on the 15-year mortgage right off the bat is, oh my gosh, it's going to cost my clients more money every month. That's true. So you understand, on a 15-year mortgage, they're not paying it back over 30 years, they're paying it back over 15 years. This means that the monthly payment is going to be higher and the total interest paid is going to be lower because you're shearing it off quicker. But I want to tell you something. There's a lot of money out there right now. You see, we've been living in a day and age of low interest rates, but the government has also been giving away and printing more money than at any other time in recorded history. We've also have pretty much zero unemployment when you look statistically. So where a 15-year product might not have made much sense before, it might make a hell of a lot of sense now because the interest rate is lower and a lot of your consumers have plenty of money and are gainfully employed, making more money than they were over the last 5 or 10 years. I want you to look at the math on this one. The purchase price of $500,000, same 5% down payment, interest rate 7% as opposed to a 15-year, which is roughly a point lower usually, so call it 6%. Yeah, sure, the monthly payment is a little higher, but friends, over the life of the loan, this consumer is going to spend $246,000 less in interest paid. That's a lot of money, $246,000 less in life of interests. If you compare the two loans on the same amortization table from 15 to 30, and you pay off the 15-year note, you'd still own 72% of the principal on a 15-year note. What do I mean by that? Here's what I mean. If you got a 15-year mortgage, at the end of 15 years, you own your home free and clear. If you got a 30-year mortgage, because of the way that amortization schedules work, after 15 years of payments, you'd still owe 72% of the principal of the loan. 15-year notes accelerate equity buildup and minimize interest paid. That's it. Friends, this is a great option for people. Next, we have the 40-year mortgage. I'll be honest with you, I find almost no value in it. This didn't work out for people long term. As a matter of fact, I put it in here so that you can understand, because I've been hearing radio ads about this. This isn't really a win. Sure, it makes it a little cheaper, but not much. The monthly payment on the 30-year was $3,160. The monthly payment on the 40-year, which historically costs a little more in interest, was $3,125. So you didn't save that much money. In interest, on a 40-year, you're going to pay over $1 million. Friends, don't get fooled by the radio ads. That's not the one for me. Lock and shop. Lots of lenders have lock and shop. Keller Mortgage has a great lock and shop. This means that borrowers get pre-approved for a loan and lock in their rates for up to 120 days. Here's what you need to know about lock and shops. Most lenders don't let you lock for 120 days. It's more like 90 days. Keller Mortgage lets you lock for 120 days. You can get with your local lenders and figure out what their lock and shop is. This is a great product if you think that when the Fed meets each quarter, rates are going to continue to go up. By the way, they've pretty much said as much, which means if you're working with buyers right now, let's play the game again. Make a list right now of the buyers that you're actively showing homes for. Then put a check mark next to the one that you know has locked in their interest rates. Then anybody that doesn't have a check mark, get on the phone with them right now in a TCPA-friendly and compliant way and lock them in. There is no reason for them to wait until rates go up in order to lock if they are out, they are shopping. I'm going to let you read the seller financing sections. There's a bunch of different options around seller financing. Here's the most important thing. The rules change state to state, and different brokerages have different views on them, which is why I'm going to let you teach this the way that you want to teach it. However, a simple land contract, a lease to own, and assumable mortgages are something that every brokerage house, in my opinion, should be educating their customers on. Your title and escrow company should be helping create these things. That's what I believe. The reason this is so important is because seller financing is the ultimate win-win, perhaps. Meaning a buyer might get under mortgage current rates on the street, and a seller might get to turn their home into an annuity when they sell. It's a great deal for people. That includes the trust deed and the wraparound. Next, home buyer assistance programs. Friends, I'm not going to wax poetically on all the different ways that the federal government and state governments try to help people buy houses. They want people in homes. I will tell you to visit www.usa.gov/buying-home so that you can see all the different ways the federal government wants to do it. They want people in houses. There's also a bunch of different state, and I'm going to leave that to you guys. That was a mouthful. Okay, we just went through a whole bunch of different products. That's not to say those are the only products. That's to say those are the ones that we highlighted. Here's the model. Understand what's going on in your marketplace to match the mortgage hack and market of the moment. Number two, understand all the current products being offered, which means you should all stop this recording, call your lender, and find out what they're offering. We hope that includes Keller Mortgage. Number three, make sure you have your list of all of your buyers in front of you and make sure that you can tell me what's best for each one of them and then go educate them. Because if you're not, friends, you can pretty much rest assured no one else is either. Then take a deep breath and go grab a protein bar or a protein shake or a Coke and a smile. Take 2 seconds, clear your mind. We're going to come back and we're going to go into understanding mortgage hacks for all of your customers that own homes with current mortgages. By the way, in case no one else told you, I think you're doing great.